Welcome back, friends. Today we are down by the river. The kids have built a shelter that they're planning to sleep out in tonight. So we'll take a quick little tour of the shelter, wrap it up, put a tarp over the top of it so they don't get wet when if it rains tonight. And we're also going to talk about some accounting while we're at it. So quick little tour of the shelter. So here's what we got. This is quite an improvement over what they've done in the past, which you can see in the background. We'll take a little tour of those here in a second, but there's the shelter. It's almost like a little cabin. So what we've got, we'll put a tarp over this, so the roof, right now the roof would probably leak a little bit, but what we have here is there's our doorway, our little entrance off to the side here. They're all gonna say hi to you if they peek their heads out there.
Hi.
We'll see them a little bit more in a second. So this is the kind of the back side. This is quite an improvement in their shelter building skills. This was the last shelter they built right over here up against this tree. Now, there were a lot more sticks here that they actually salvaged off to build that one. So this was a solid wall, had grass on it. It was actually pretty well sealed in, functioned very well. They spent one night out in that earlier this summer, but now we have kind of upgraded, or they have upgraded to that shelter, which they will be spending the night in tonight. So we're going to get a fire going here in a little bit. In the meantime, I'd like to talk a little bit about the income statement. As I mentioned a minute ago, we'll be talking about the income statement in addition to working on the shelter and getting ready to camp out this evening. So what I wanted to start with was uses and limitations of the income statement. So we'll start with the uses. The income statement, as we've mentioned in prior discussions, reports and measures the performance of a company's operations for some period of time. So that's critical. We need a period of time, and it's supposed to measure the company's performance or the inflows and outflows regarding how the stockholders or the equity holders performed for that period of time. So that is what the income statement is trying to do. In conjunction with that, the primary use of the income statement for equity investors who are trying to allocate their capital is so that they can use that to predict future cash flows. They want to predict future cash flows. That's the primary objective. That's what the value that they're willing to pay for the stock is based on, is what's the future cash flows of this company and what am I willing to pay for those cash flows. That should reflect the value that they're willing to put in the equity of that company. And the income statement, the objective of the income statement is to provide them information, provide equity investors information to project what the future performance or the future cash flows will be of the company. It does that by providing information about past events. So how did the company do in the prior period? That I'm going to use that information as an equity investor to project and predict how the company is going to do in a future period, say next quarter. So from an external financial statement user perspective, it provides three main pieces of information regarding future cash flows. It helps them estimate the amount of future cash flows, the timing of future cash flows, and any uncertainty associated with those cash flows. Will they get them? Will they not get them? What's the volatility? Might they get all of this in a year, or might it stretch out evenly over 20 years, or are they going to have to wait 20 years to get any of it? So that information is provided to equity investors in terms of helping them assess the value or the amount they're willing to invest in a company. So those are the uses or the primary uses of the income statement. That brings us to some of the limitations of the income statement. The income statement has a lot of limitations. These limitations, some of them are specific to the income statement. However, a lot of them, they just apply pretty much to all of accounting in general. And it deals with, I would say, failures in regards to what we're trying to do in accounting. So failures to identify, measure, and communicate information. If accounting's goal is to identify, measure, and communicate, then a failure is that it doesn't identify, measure, and communicate information in the most efficient and effective manner possible. So when we talk about the identification, what are the limitations of the income statement in terms of identification? And one is we're capturing this performance of the company, but we don't take into account any performance related to intangible assets. So if a company develops, say, a great brand image, then that's not captured in the performance of the company. It's not captured in the income statement because accounting doesn't capture reputation at all. It's nowhere in the financial statements, therefore it's not reflected in the income statement either. That's one type of intangible asset. Trademarks, a lot of patent costs and patent value is not captured in the income statement. We see that a lot with companies like Tesla, who you could argue a lot of their value is in their patents regarding battery technology or self-driving car automation. A lot of their value is in those items. They're not reflected on the income statement or the balance sheet for that matter. We don't have a great way of measuring and capturing that, so it doesn't come out on the income statement. And there is some uncertain future revenues and expenses that accounting just doesn't identify well. So that's another area where it fails to identify information and even consider it, let alone measure it. And that takes us to our next goal of accounting, which is to measure. The income statement in general, it provides an imprecise measure of a lot of items. It relies on estimates for many items, say warranty costs, litigation costs, a lot of uncertain assets and liabilities that the income statement reflects portions of, or what we think a best estimate is of what we expect that to be. So there's a lot of other estimates, say bad debt expense is an estimate to a large extent when it hits the income statement. So imprecise measurement. And then measurement of even the same item can be different across companies depending on which accounting standards they rely on, or which option they take within a set of accounting standards. So one company might value inventory under FIFO, and one company might value it under LIFO or weighted average costing. That creates some variability from company to company about what the expenses, what cost of goods sold in that case would be from any period of time, just based on the fluctuations of income and how they relate to the inventory method the company has chosen. So there's some variability that accounting has when it comes to presenting the income statement that reduces comparability when we get to usefulness and the relevance of information. And lastly, there's incomplete and delayed communication of this. So as we just mentioned, we're constrained to the things accounting can identify and measure. So we can't communicate all the information or all the performance information of a company, just one little piece that accounting has decided we're going to try to communicate, principally because we believe it's reliable information, whereas intangible assets we've chosen not to do anything with because there's no reliable way to measure them on the income statement, so we essentially ignore them. Also, timeliness. The income statement doesn't come out for at least probably 4 weeks for a company. That means that's the most recent information contained in the income statement is 4 weeks old, let alone information from the beginning of the quarter or the beginning of the year, depending on the timing of the releases, where that information could be 3 months old or 4 months old easily in the income statement. Now, this became very evident when we had the pandemic. So the pandemic basically started the middle of March. So what was Q1 for most companies? So Q1 of 2020, the pandemic starts. Companies are reporting their financial statements for the first quarter as of the end of March for calendar year-end companies. So they're reporting the financial statements and their financial condition as of March 31st. So in April, when they start having their press releases and sending out information towards the end of April, the information they're presenting is from as of March 31st. Well, in the meantime, basically the entire country and large parts of the world shut down and ceased to operate. So that information that was being disclosed in conjunction with the financial statements for Q1 was largely irrelevant. At least 3/4 of it was. And you saw that when you listened to some of these conference calls where the company's talking about their Q1 performance. And a lot of times what they would end up doing is they would go very quickly through the Q1 performance, or at least for the first 2 months or 2.5 months of Q1, and then focus really heavy on either the very end or even the most recent, like what happened last week or 2 weeks ago that they had internal information on. And that was basically discounting, like, okay, yes, our financial results are this as of Q1. However, we have all this new information, which wasn't necessarily wasn't financial statement information at all, but it was very valuable information. So that revealed the weakness of the timeliness of financial statements and timeliness of the income statement, particularly during times of rapid transition, like when we had the pandemic in 2020. So those are some limitations. One of the limitations we run into is, as I talked about, kind of this measurement. There's a lot of estimates that go in. Anytime we have an estimate, it's a little bit harder to reliably measure, in the sense that it can't be easily verified. we talked about how management, when we talked about Market for Lemons, management has a lot more information than other parties, including auditors who are responsible to audit and verify the information. So one of the things management can do is they can kind of tweak some of their estimates or assumptions if they need to move their financial statements or financial performance around a little bit. So the imprecision of accounting measurement provides some latitude for management to introduce bias into net income. This is called earnings management. So earnings management is management or managers changing the accounting in order to achieve some desired level of earnings. What we've seen is some evidence, or what appears to be some evidence of this, and this reduces the faithful representation of income and thus reduces the value of net income to users of financial statements. So one of the big focuses or big things that we've seen that demonstrated this, or people point to as an evidence of this, is what they call an earnings discontinuity. So what they do is they plot the earnings of all companies in the universe, or of public companies usually. So public company managers have the very big incentives to meet earnings benchmarks. One of those is reporting positive earnings, i.e. not a net loss, reporting net income. Even if it's really, really small, reporting some net income is better than reporting any net loss at all. So there's it's kind of a discontinuity at that point. So what they look at in this regard is they plot out the earnings of all companies, all public companies in the country. And I think at the time they were doing this, there were roughly 4,000, 5,000 companies, public companies that you had this information available for. And what we see in this graph is that it's far less likely for companies to report just a little net loss than it is for them to report a very little net income. So it's almost like companies who report a little net loss are able to just tweak things just enough to push themselves over to a net income. And that creates this this discontinuity within what you would think of as a distribution. So that's one thing people point to a lot in terms of providing what they say is evidence that management is actually actively manipulating their financial statements in order to achieve an objective, in this case, net income at all. With that, we're going to take a little break here. We're going to get back to talking about some of the elements of the income statement in a little bit. What are you boys thinking here?
Cool!
What we're going to talk about now are the elements of the income statement, starting with the format of the income statement. There are two predominantly used formats for the income statement. The first one is a single step, and the other one is a multi-step. Very straightforward. You either have one or multiples. First of all, in a single step statement, we combine all of our revenue and all of our expenses. So we have our revenue, one sales account, or however many, we just put them all together, and we put all of our expenses together, we have net income at the bottom. This doesn't give any priority to any type of revenue or expenses, or try to match up revenue to expenses. For instance, it doesn't match up cost of goods sold to revenue. It just lists that as all of your expenses, whatever. So your cost of goods sold are just one type of expense. You don't get reported any kind of gross profit figure like you would in a multi-step income statement. Because of that, this method is rarely used, at least in industrial companies. Most companies try to break out their revenues and expenses into meaningful categories to help you assess how the company is doing in regards to, say, their primary operations. For instance, what's their gross profit? Is it going up or is it going down? That's valuable information to investors. So companies oftentimes or frequently will report that information, and that brings them to a multi-step income statement. So in a multi-step income statement, which is by far the most common, it separates operating expenses, revenues and expenses, operating transactions like revenues and expenses from non-operating transactions, and then gains and losses separately. What this allows the company to do is it matches the costs and expenses with the related revenues, so that you end up with a gross profit figure before you end up have selling and general administrative expenses, and then let's say gain interest revenue, which is not operating revenue, it's interest revenue, or interest expenses down below. It provides a lot more value to investors or to users of the financial statements, so that they can understand maybe how are different aspects of the business performing, like what's sticking out as problematic. Is it the company's not even able to make revenue based on just the costs of the merchandise they're selling, which means they would have a negative gross profit? That would be a problem. Or is it something else sticking out, like they have a ton of interest expense, or their SG&A is really eating everything up? So that's the multi-step. It highlights certain components of income that analysts use in assessing financial performance. So it provides a little bit of extra value there. So that's the general format. We either have a single step or a multi-step. We also are then going to have operating sections. So within the operating section, we're going to have revenues. Revenues are inflows or other enhancement of assets or settlements of liabilities that constitute the entity's ongoing major or central operations. The key here is the ongoing major or central operations. Most people can identify inflows or other enhancements of assets or reduction settlements of liabilities. That's the easy part. It's an inflow usually. It's pretty identifiable. The key here is ongoing major or central operations. So this is typically your sales account. However, that can be very different. If you are a company, for instance, that manufactures equipment, let's say I manufacture bulldozers and I sell bulldozers. Well, that's revenue to me because my ongoing major and central operations involves the manufacture and sale of bulldozers. Now, we'll take the other side of that. Let's say I'm a construction company and I buy bulldozers and use them in my operations. And then when I'm done or when they get too old or too costly to maintain, I then sell them, either as scrap or to someone else who could use them. Now, if I'm a construction company and I'm selling a bulldozer, that's not my ongoing major and central operation. It's not revenue to me as a construction company when I sell a bulldozer. I'll take a gain or a loss, which we'll talk about here in a second. So our revenue is associated with our ongoing major and central operations, and that deals with what the operations are, not what you're selling. So we match up revenues to expenses. Expenses are kind of the flip side of revenues. These are outflows or other using up of assets or an incurrence of liabilities that constitute an entity's ongoing major or central operations. Same thing, ongoing major and central operations. Cost of goods sold, depreciation, interest expense, rent expense, salaries and wages, taxes. These are expenses because they are associated with the company's ongoing major or central operations. Now, on the flip side, we have revenues and expenses, which are from basically the company's main operations, and then we have gains and losses. These are basically everything else. So gains are increases in equity or net assets from peripheral or incidental transactions, and losses are just the opposite, decreases in equity or net assets from peripheral or incidental transactions. So gains and losses. This is the case where that construction company sells a bulldozer. If it sells it for more than what it's carrying it on its books for, it's going to have a gain. It's not revenue, it's a gain. They made money, at least they made money from an accounting perspective, and that gets reported generally separately, especially when you're dealing with a multi-step income statement. That gain gets reported separately than it does from revenue. Why? Because that's not my main operations. You don't want a gain from the sale of a bulldozer going into revenue. It may, depending on the size of the asset you're selling, it's a big piece of land, for instance, it may make it look like you had a great quarter because of your revenue, or your revenue went up a lot. If you put gains or the revenue side of gain transactions in there, it has nothing to do with your ongoing operations. It would reduce or substantially reduce the predictive value of your financial statements. So we separate out gains and losses and put them in separately in the income statement. So some of these transactions that get put into gains and losses would be sale of investments or plant assets, settlement of liabilities, write-off of assets. So those are types of things that end up in gains and losses as opposed to revenues and expenses. There are some additional or other items that we do. First of all, income taxes. Income taxes, reported taxes levied on income from continuing operations. The key here is from continuing operations. We'll talk in a minute or in a little bit about intra-period tax allocation, and that just means allocating the taxes between different things within the period, intra-period allocation. So income taxes is usually taxes levied on the income from continuing operations, i.e. not from stuff that were, or operations that were not continuing or discontinuing. So that brings us to the next point. So that's income taxes. Next, we have discontinued operations. Discontinued operations are gains and losses resulting from the disposal of a component of the business. These are reported net of tax, which means we take the tax impact out. But the idea here is if I have this segment of the business that I'm not going to have in the future, for instance, I sold it off for whatever reason, I sold this segment off. It's not going to be a continuing operation. I don't want the gain or loss on the sale or the net income from that component or from that operation sitting in my revenues and expenses, because it makes them less predictable, because that piece of my revenues is gone. We will never see it again. If it contributed 25% to my revenues, I don't want it in there, because now the first question investors are going to ask, well, okay, well, you sold off this massive section of your business. What's your revenue going to look like going forward? Well, we can preempt that concern by pulling it out and sticking it in its own item. We call that discontinued operations. And again, these are gains and losses resulting from the disposal of a component of the business. The next other item, we have non-controlling interest. This is allocation of income to non-controlling shareholders. We'll talk about this a little bit more in a minute. And then lastly, we have earnings per share. So those are kind of, if we walk down the income statement, we have revenues, expenses, followed by gains and losses. We then usually report income taxes from operations, income taxes from continuing operations. And then we have net income from continuing operations, followed by our discontinued operations discussion, which gives us net income. And then we take a portion of that out and say, okay, well, not all of that belongs to the shareholders of my business. Part of that's non-controlling interest. So then we usually reduce it or add to it if it's a loss from non-controlling interest. So we then take that piece. So non-controlling interest comes out of net income, which then gives us net income available to the shareholders of my company. And then we divide that by the number of shares outstanding and gives us earnings per share. So that's the general layout. What we have is generally a financial statement at this point, and that lays out the whole financial statement. We can condense our financial statement. To condense our financial statement, instead of providing every single account in our financial statements, we lump them into big categories. So we say revenues, or we break out sales into like 1 or 2 categories, and then we break out expenses maybe into 3 categories: cost of goods sold, SG&A, or selling general administrative is what SG&A stands for, and marketing expenses. And that's really it until we get to say net income, for instance, or sorry, income taxes. That's a condensed financial statement. It provides summary figures instead of the detail. And the detail is often instead just provided in notes to the financial statements. So we look at the notes into the financial statements to find the detail, and that makes the financial statements, the face of the financial statements, the income statement itself, a little bit more easy to understand. That's what we see when we look at most public companies. They condense their financial statements. You'll look at, say, a company like Walmart, which is an enormous company. Their financial statements, their income statement probably has maybe half a dozen really individual line items on it of information. If you want more detail, you have to go into the notes of the financial statements. So we're going to talk about adjusted earnings. Now, on our income statement, we have net income. That's a GAAP figure. We know exactly how you're supposed to get net income, what has to get included in net income, and what can get excluded from net income, which we haven't talked too much about at this point. But we have net income. Now, companies don't always like the way GAAP or accounting treats different items. They might think that, well, we did a big, let's say a big restructuring that costs a lot of money. We don't want investors to see that information and think that that's going to be indicative of what's going on in the future. So they'll pull that out. When they do that, they report something called adjusted earnings. And they call it that. If you looked at the press release of Walmart or Tesla or any number of public companies, you would see what they call adjusted earnings. Now, what the companies adjust out of earnings varies by company, and it even varies by company within a period. Sometimes they might adjust one thing that they think is unusual and needs to get taken out. Other times they'll adjust something else. Now, what this ends up doing when companies end up reporting adjusted earnings, a lot of times, that's for kind of known items. For instance, a lot of companies report earnings before interest, taxes, depreciation, and amortization. Something that's called EBITDA is an adjustment. EBITDA is not an accounting number. You won't find a definition of EBITDA within GAAP anywhere. Now, you'll find a definition of earnings, interest, taxes, and depreciation, amortization, so you can back into it. But that's something that a lot of companies will report that's not income. It is not a GAAP figure. There's also a lot of other things, just EBIT, which includes depreciation, amortization, operating income, which isn't quite net income. It doesn't include some of the other expenses, but it usually ends up on a lot of income statements. So again, that comes largely off. Now, companies that don't necessarily report net income or they report adjusted income, they do have to reconcile this. The Securities Exchange Commission for public companies require companies that talk about something that's not GAAP to reconcile it to what they would call its nearest GAAP equivalent. Now, if it's something like EBITDA, that's pretty simple. You just take earnings and then you take out depreciation, amortization, taxes, and interest. That gives you EBITDA. However, if you're adjusting out for, say, a restructuring costs, that's going to be its own separate line item. Now, sometimes this is very legitimate and companies have a good reason to do that. Maybe sometimes investors even ask them, could you tell us what's earnings if you were to take this thing out? We know you did a big restructuring, or we know you had a lot of costs associated with starting up this new plant or this new facility. What would your net income look like if you didn't have those costs? Like, what would you kind of project those costs to be. Investors might want that information, which the company then provides them adjusted earnings, adjusted for what, frankly, investors are kind of looking for. But I would say at the same time, there's a lot of adjusted earnings by companies that do not really reflect anything other than management potentially just trying to make earnings look better. So instead of reporting top line net income, they're reporting top line adjusted earnings or adjusted income, and they can adjust it for all kinds of things: acquisition related costs, debt reduction, redemption costs, special charges for whatever they want to call those, investment losses. Occasionally you'll get companies who add stuff back in, but don't often see companies adding expenses back in and making earnings worse when they do adjusted earnings. But occasionally you do. This is concerning. The SEC has addressed it. The most notably, they started requiring companies to actually report this reconciliation, which allows it. They have to lay it all out. If they're adjusting their earnings from anything other than GAAP, then they have to show what's those adjustments for. In general, the concern is that those adjusted earnings at the abusive end allow management to manipulate and introduce management's bias into the reporting, which the SEC, by forcing them to disclose it, is kind of trying to get around that, to at least give give investors the information they need to reverse engineer adjusted earnings. And whether they do it or not, the SEC can't control that, but they can at least force a company to provide it. So after dinner, we'll come back and we'll talk a little bit more about how we report various items on the income statement. So the boys came over here, they found a vine that goes over this little creek, so. And they're all over the dry creek. One big cheer, boys. Thanks for watching. Hopefully you enjoyed this video. If you enjoyed this video, give it a thumbs up. If you would like to see the next video in the series, click right up here. If you'd like to see other videos in this series, click down here. If you would like to subscribe and get updates, click right over here. Thanks for watching and have a great day.